The bond market is bigger than the stock market. Not slightly bigger, almost 3 times bigger. And the overwhelming majority of people who consider themselves financially literate, people who check their portfolios, follow earnings reports, debate which stocks to buy, cannot explain what a bond yield is or why it moved last week. That gap is not an accident. What they don't tell you about bonds is that you don't have to own a single one for the bond market to control your financial life. The rate on your mortgage, the interest on your car loan, the cost of carrying a credit card balance, the salary your employer can afford to pay you. Every one of those numbers has a bond yield somewhere upstream of it. The bond market sets the price of money itself, and if you don't understand how it works, you are navigating your entire financial life using half a map. Here is what the real reason your interest rate moved last year had nothing to do with your credit score. It had everything to do with a market most people have never looked at once. What a bond actually is, strip away every piece of financial jargon, and a bond is a loan you give to a government or a corporation. That is the whole thing. They need money now. You have money now. You give it to them. They promise to pay you back at a specific date, the maturity date, plus regular interest payments along the way, called the coupon. When the term ends, you get your original amount back. A 10-year U.S. Treasury bond issued at $100 with a 4% coupon pays you $4 a year for 10 years, then returns your $100. Simple enough. Here is where it stops being simple. Once a bond is issued, it can be bought and sold on the open market, just like a stock. And the price it trades at changes constantly based on supply, demand, and most importantly, what interest rates are doing in the broader economy. And this is the relationship almost nobody teaches. The one that makes the bond market the most powerful pricing mechanism in the global economy. Bond prices and bond yields move in opposite directions, always. When the price of a bond goes up, the yield, the effective interest rate, goes down. When the price falls, the yield rises. This sounds like a technical detail. It is not a technical detail. It is the mechanism that connects a decision made in a government building to the rate a family pays on a 30-year mortgage. Understanding this one relationship rewires how you read every financial headline you will ever encounter. Before going further, one concept worth locking in: the yield curve. The yield curve is a snapshot of bond yields across different maturity lengths: 3 months, 2 years, 10 years, 30 years. Normally, longer-term bonds pay higher yields than short-term ones. That makes intuitive sense. Lend money for 30 years, and you expect more compensation than lending for 3 months. When the curve looks the way it normally does, sloping upward, investors are confident in the economy. They are pricing in growth. When short-term yields rise above long-term yields, the curve inverts. And an inverted yield curve has preceded every U.S. recession since World War II. Not most of them. Every one. The yield curve inverted sharply in 2022, stayed inverted through 2023. Economists argued about what it meant, while the people watching their mortgage applications come back with numbers that made houses unreachable, understood it viscerally, even if they couldn't name the mechanism. The reason this matters here is that the yield curve is not a prediction tool for professional investors. It is a signal that is publicly available, costs nothing to read, and has a more reliable track record than virtually any market analyst on television. Most people have never looked at it once. Why the bond market controls interest rates. Here is the connection that changes everything. The Federal Reserve sets a short-term benchmark rate, the federal funds rate. That rate directly controls overnight lending between banks. What it does not directly control is the 10-year Treasury yield. And the 10-year Treasury yield is the number that most long-term interest rates in the economy are anchored to, including the 30-year fixed mortgage rate. The 10-year yield is set by the market, by bond buyers and bond sellers, every day, pricing in their collective expectations about inflation, economic growth, and the future trajectory of Fed policy. This means that even when the Federal Reserve stops raising rates, even when it starts cutting them, mortgage rates can stay elevated if the bond market has decided that inflation is not finished or that the government is borrowing too much. That is exactly what happened between 2023 and 2024. The Fed signaled rate cuts. The market priced in rate cuts. Mortgage rates did not fall meaningfully. Bond investors looked at the size of the U.S. deficit, looked at the supply of new Treasury bonds being issued to fund it, decided the risk of holding long-term debt was too high, and demanded higher yields to compensate. The bond market overruled the narrative, and most people had no framework to understand why their mortgage rate wasn't falling the way every financial media outlet had promised it would. If you have been watching stock prices for years as your primary read on the economy, you have been watching the passenger window while the bond market drives. The people who understood that in 2022 saw what was coming before it arrived, not because they had inside information, because they were reading the right market. If this channel is the first place that has explained this to you plainly, without selling you a course or a fund, hit the like button. What you are getting here is what most financial content buries or skips entirely because it does not have a product attached to it. The 2022 bond crash, the most important financial event most people cannot explain. In 2022, the bond market experienced its worst year in over 2 centuries of recorded U.S. financial history. Long-term Treasury bonds lost more than 30% of their value. The Bloomberg Global Aggregate Bond Index, a benchmark for investment-grade bonds worldwide, fell over 16%. These are assets that were held by pension funds, insurance companies, regional banks, and retail investors who had been told that bonds were the safe part of a diversified portfolio. None of that protection materialized. The mechanism was straightforward. The Federal Reserve, having held interest rates near zero for over a decade, moved faster and further than at any point since the 1980s. As rates rose, existing bonds, which paid the lower coupons locked in when rates were near zero, became less valuable. Nobody wants to hold a bond paying 2% when new bonds are paying 5%. So prices collapsed and yields spiked. The 10-year Treasury yield went from under 1.5% at the start of 2022 to over 4.2% by year-end. The practical consequences fell on people who never owned a single bond. Mortgage rates tracked those yields up. The average 30-year fixed rate crossed 8% for the first time since 2000. Home affordability collapsed to its lowest level in decades. First-time buyers who had spent years saving for a down payment found that the house they could afford in 2021 required monthly payments 40 to 60% higher than it would have 2 years earlier. The bond market had repriced, and ordinary people absorbed the cost. Save this video. The next time a financial headline mentions yields, rates, or the Fed, what follows here is the framework to actually understand what is being said and what it means for decisions you are already making. Who actually controls the cost of your money here is the part of the bond market story that most financial content will not say plainly. Bond markets have, on multiple occasions, effectively overruled elected governments. In 1994, the Clinton administration entered office with ambitious spending plans. The bond market responded by selling off Treasury bonds aggressively, driving yields sharply higher, and raising the cost of government borrowing. James Carville, Clinton's political strategist, famously reflected that he used to want to come back as the president, or the Pope. After watching bond markets constrain an administration's entire policy agenda, he said he would rather come back as the bond market, because the bond market can intimidate anybody. In 2022, the United Kingdom's government under Liz Truss announced a sweeping package of unfunded tax cuts. The bond market reacted within hours. Gilt yields, UK government bond yields, spiked so sharply that pension funds across the country faced margin calls and near collapse. The Bank of England intervened as an emergency measure. The policy was reversed within weeks. The Prime Minister resigned within 45 days. The bond market ended a government. Now here is the pushback worth taking seriously. Some economists argue that bond market discipline serves a legitimate function, that it prevents irresponsible fiscal policy and protects currency stability. That is a genuine counterargument with intellectual grounding, and it is worth sitting with, because the discomfort it produces is real on both ends. Markets imposing constraints on democratic decisions is uncomfortable, Government spending without constraint is also uncomfortable. The tension does not resolve cleanly. What does resolve cleanly? The person who understood how bond markets work saw both of those events coming before the headlines arrived. The person who did not understand them read the outcomes in confusion and filed them under complicated financial stuff and moved on. One of those people is in a stronger position the next time it happens. How to actually read the bond market. 3 signals. None of them require a brokerage account or a Bloomberg terminal. The 10-year Treasury yield, publicly available, updated in real time, free to look up. When it rises significantly, borrowing costs across the economy follow. Mortgages, auto loans, corporate debt, student loan rates, all of them are priced off this number or influenced by it directly. Watching this number costs nothing and tells you more about where interest rates are heading than most financial commentary. The yield curve spread, specifically the 2-10 spread, the difference between the 2-year Treasury yield and the 10-year Treasury yield. When the 2-year yield rises above the 10-year, when the spread goes negative, the curve has inverted. As established, every U.S. recession since World War II was preceded by an inverted curve. The spread is publicly tracked and reported daily. It is not a guarantee. It is the single most reliable leading economic indicator available to anyone with an internet connection. Credit spreads. The difference in yield between corporate bonds and equivalent Treasury bonds. When credit spreads widen, when corporations have to offer significantly higher rates than the government to attract buyers, it means the bond market is pricing in higher risk of default. Widening credit spreads preceded every major market disruption of the last 30 years. They are a fear gauge, and they move earlier than stock prices. None of this is insider knowledge. All of it is publicly available. The question worth sitting with, genuinely sitting with, not filing away, is why a market that controls the cost of borrowing for every government and household on Earth, that has ended political careers and reversed national policy, that triggered the worst housing affordability crisis in a generation, is almost entirely absent from the financial education most people receive. Who benefits from that gap? This is the channel for people who want the answer to that question, not a comfortable version of it. If that is you, and the fact that you are still here at this point in the video suggests it is, subscribe. What gets covered here is what financially sophisticated people understand, and most retail-focused content quietly avoids. The signal most people miss right now. The most important thing to understand about the bond market in the current environment is that the era of cheap money that defined the decade between 2012 and 2022 was the historical anomaly. Interest rates near zero for 10+ years were not normal. They were an emergency measure, extended well past the emergency, that restructured the entire economy around cheap debt. Asset prices inflated. Corporate buybacks replaced capital investment. Governments borrowed at costs that made debt feel nearly free. The bond market spent 2022 through 2024 repricing that assumption. And the repricing is not finished. The U.S. government is currently running deficits that require issuing trillions of dollars of new Treasury bonds annually. More supply of bonds means more competition for buyers. More competition for buyers means higher yields to attract them. Higher yields mean higher borrowing costs across the economy, for the government, for corporations, and for individuals. The watch-through reward, the thing worth screenshotting, the thing worth sending to someone, is this. The Federal Reserve does not control long-term interest rates. Bond investors do, and bond investors are currently looking at a government borrowing at a pace that has no modern precedent in peacetime, pricing in what it will cost to finance that debt for decades, and demanding more yield to hold it. Every forecast about falling mortgage rates and returning affordability depends on bond investors deciding the debt load is manageable. If they decide otherwise, rates stay elevated regardless of what the Fed does. That is not a political observation. It is a mechanical one. And it is the piece of the puzzle that almost every mortgage rate conversation in financial media leaves out entirely. The next video on this channel goes one level deeper into this, specifically into how deficit spending interacts with bond yields and what happens when a government loses the confidence of the bond market entirely. It has happened before, in countries that considered themselves immune to it. The conditions that triggered it look more familiar than they should. Share this one first, specifically with someone who has been waiting for mortgage rates to fall and cannot understand why the Fed cutting rates did not make it happen. This video is the explanation they have been missing. There is a version of this topic that ends here with a neat conclusion, a confident forecast, and a clear set of instructions. This is not that version. Because the honest answer to the question of who controls the cost of money, governments, central banks, or the bond market, is that the answer shifts depending on circumstances nobody fully controls, and the shift happens faster than most people can react. What does not shift is the advantage of understanding the mechanism before it matters. The bond market is not where money goes to rest. It is where money goes to set the rules for everything else. The question worth leaving with: if bond investors can effectively set the terms under which elected governments spend money, and the historical record shows they can, what does that mean for the idea that democratic elections determine economic policy? Leave the answer in the comments. Not the comfortable version, the one you actually think when you sit with it.